Imagine two traders. They use the same strategy. They trade the same market. They have the same chart setup, the same entry, the same stop loss, the same take profit. Yet one trader becomes consistently profitable while the other continues to lose money month after month. How is that possible? Most traders would immediately blame the strategy. They would assume that one trader has discovered some secret indicator, a better entry technique, or some hidden edge that nobody else knows about. But what if I told you that the biggest difference between winning traders and losing traders has very little to do with strategy? What if the real battle is happening somewhere far more important? Inside the mind. Welcome to Market Psychology. Today, we're going to explore why most traders lose money and why the problem is usually not their strategy. Because until you understand this, you'll continue searching for solutions in the wrong place. And that search can cost you years. Most traders begin their journey with a simple belief. If I can just find the right strategy, I'll start making money. So they begin searching. They watch YouTube videos. They buy courses. They join signal groups. They test indicators. They jump from one strategy to another. One week they're trading support and resistance. The next week, they're trading moving averages. Then supply and demand. Then ICT. Then smart money concepts. Then price action. Then something else. And the cycle continues. The problem isn't that these strategies don't work. Many of them do. The real problem is that traders believe the strategy itself is responsible for success. Think about it. Professional traders all trade differently. Some are scalpers. Some are swing traders. Some trade fundamentals. Some trade pure price action. Yet, they can all make money. If strategy alone determines success, then only one strategy would work. But that's clearly not the case. The truth is uncomfortable. Most traders don't have a strategy problem. They have an execution problem, and execution is psychological. Here's something fascinating. Most traders already know what they're supposed to do. They know they should. Risk only a small percentage per trade. Follow their plan. Use stop losses. Remain patient. Avoid revenge trading. Stay disciplined. The knowledge is there. The problem is applying it consistently. Think about fitness. Everyone knows that exercise is healthy. Everyone knows that eating properly is beneficial. Yet millions of people struggle with consistency. Why? Because knowledge and behavior are not the same thing. The same principle applies in trading. Knowing what to do is easy. Doing it repeatedly under pressure is difficult, and that's where psychology takes over. The market is one of the few environments where emotions are constantly tested. Fear, greed, hope, frustration, excitement, impatience. Every trade has the potential to trigger one of these emotions. Let's talk about fear. A trader enters a perfectly valid setup. The trade moves slightly against them. Nothing unusual. The setup is still valid. But fear begins to grow. What if I'm wrong? What if I lose money? What if the market crashes? The trader exits early. Minutes later, the trade reaches the original target. The strategy worked. The psychology failed. Now let's look at greed. The trader has a winning trade. The target is approaching. Everything according to plan. Then, greed appears. What if it goes even further? The trader removes the take profit. The market reverses. A winning trade becomes a losing trade. Again, the strategy worked. The psychology failed. This happens every day. Not because traders lack knowledge, but because emotions overpower discipline. One of the most expensive psychological mistakes in trading is impatience. Markets spend most of their time doing nothing. Professional traders understand this. Beginners struggle with it. They feel the need to be involved. They want action. They want excitement. They want to feel productive. So they force trades. They enter setups that don't meet their criteria. They chase price. They manufacture opportunities that don't actually exist. The result? A series of unnecessary losses. The irony is that successful trading often looks boring. Great traders spend more time waiting than trading. They understand that patience is not inactivity. Patience is a competitive advantage. The ability to wait separates professionals from amateurs. Now let's discuss one of the most destructive behaviors in trading: revenge trading. A trader loses a trade, then another, and another. The losses begin to feel personal. The trader becomes frustrated. Instead of following the plan, they start trying to recover the money immediately. Position sizes increase. Rules disappear. Emotions take control. At this point, trading is no longer about opportunity. It's about emotional relief. The trader is trying to eliminate the discomfort of losing. And that mindset creates even more losses. The market doesn't care about your previous trade. It doesn't care about your emotions. It simply does what it does. But traders often bring emotional baggage from one trade into the next, and that's where accounts get destroyed. One of the biggest differences between amateurs and professionals is how they think. Most beginners think in certainty. Professionals think in probabilities. A beginner wants to know, will this trade win? A professional asks, does this trade have a positive expectancy over a large sample size? That difference changes everything. Professional traders understand that losses are part of the business. They don't expect every trade to work. They don't need to be right every time. They focus on consistency. Think about a casino. A casino doesn't panic because one customer wins. It understands the long-term probabilities. Trading works the same way. Your edge doesn't reveal itself in one trade. It reveals itself over many trades. The trader who understands this becomes emotionally stable. The trader who doesn't becomes emotionally reactive. Discipline is where profitable traders are created, not motivation, not excitement, not confidence, discipline. Because there will be days when you don't feel like following your plan. Days when losses make you question everything. Days when emotions become intense. Those are the moments that define a trader. Anyone can follow rules when things are going well. The challenge is following them when everything feels uncomfortable. Discipline allows you to execute your edge consistently. Without discipline, even the best strategy becomes useless. Most traders spend years searching for the perfect strategy. They move from system to system, indicator to indicator, course to course, believing that the next strategy will finally solve their problems. But eventually, every trader faces the same realization. The greatest obstacle is not the market. It is not the strategy. It is not the broker. It is not the indicator. It is the person looking back at them in the mirror. Because trading is ultimately a test of emotional control, discipline, patience, and self-awareness. And the traders who master those skills gain something far more valuable than a new strategy. They gain consistency. If you enjoyed this video, subscribe to Market Psychology and join us as we explore the mental side of trading success. Remember, master your mind. Master the market.